Nobody told you that small accounts die from good trading. They told you to manage risk, be disciplined, follow your rules, execute your plan, and you tried. You did all of it. And somehow your account is still shrinking, or it's stuck, or it grew a little and then gave it all back in one session. And you're sitting there wondering what you're missing. What the people with bigger accounts seem to know that you don't. I want to tell you something right now, before anything else. The reason most traders with accounts under $10,000 fail is not because they trade badly. It's because they trade correctly with the wrong objective. And that's the thing nobody is talking about. Think about that for a second. You've been executing maybe better than you ever have. You've been stopping out where you said you would. You've been sizing down. You've been patient. And the account is still not doing what you thought it would do. That feeling isn't confusion. That's the system working against you. Not because the market is unfair, and not because you're not good enough, but because you are playing a game designed for a different account size, with rules and metrics that were written for someone who already has more money than you do, and following those rules exactly, that's what's killing you. I spent a lot of years thinking the gap between successful traders and struggling ones was psychological. And it is. It's almost entirely psychological. But I missed something important for a long time. Something that took me far longer than it should have to see clearly. The psychology itself is account size dependent. The right mental approach for a $50,000 account is genuinely, fundamentally different from the right mental approach for a $5,000 account. Not a little different, structurally different. And when I finally understood that, it changed the way I thought about everything that comes before the actual trade, the intention you bring to it, the thing you're actually trying to accomplish. So let me give you that now, before we go anywhere else. Here it is. The only strategy that actually works for a small account is this. You are not here to make money. You are here to build the mental software that money will eventually run on. That's it. That's the whole strategy. Not a technique, not a setup, not a system, a different objective entirely. Your account is a laboratory, not an income source. And the moment you try to make it an income source before it's ready to be one, you corrupt the laboratory and you learn nothing, even if you win. I know that sounds like something you'd dismiss. You've probably heard versions of focus on the process, not the profits, 100 times. And it's always felt like something people say to make losing more palatable. I understand that. I dismissed it myself for years. But I'm not asking you to accept it right now. I'm asking you to stay with me through what I'm about to show you, because there is something specific underneath that idea that most people, even people who say they believe it, never actually find. And once you see it, you'll understand why the advice always felt hollow. It was pointing at something real, but nobody ever showed you the real thing directly. Let me tell you about a trader I worked with early in my career. He came to me after 3 years in the markets. He was not a bad trader. He had real skill, genuine pattern recognition, a feel for price action that took most people much longer to develop. But his account had never grown past $8,000, and he'd started with 6. After 3 years, he'd had winning weeks, winning months even, but the account just wouldn't grow in any durable way. And when I sat with him and really went through his decision-making, I found something I'd started to see over and over again in traders who came to me frustrated and confused and nearly done with the whole thing. He was making fear-based adjustments to good setups. Not bad setups, good ones. He would find a setup he genuinely believed in, size into it appropriately, and then at the first sign of normal volatility, the first normal pullback that was entirely within the expected range of movement, he would exit. Not because the trade was wrong, because he couldn't afford to be wrong, financially or emotionally. And so he was turning good trades into bad outcomes, consistently, because the cost of losing felt too large relative to the size of what he was trying to protect. This is what happens when you treat a small account as a source of income or financial security. The moment the account becomes something you need, something you cannot afford to lose, it triggers a protective response in your nervous system that overrides your judgment. Every single time. It doesn't matter how good your rules are. The rules live in your prefrontal cortex, the planning, rational part of your brain. The fear of loss lives somewhere much older and much faster than that. And when that older system activates, the rules don't stand a chance. You'll break them and tell yourself a story about why you had to. That story always sounds reasonable. It is never true. The trader I was working with wasn't undisciplined. He was disciplined in the way that someone terrified of falling is disciplined, gripping too hard, overcorrecting, exhausting himself managing a fear that had nothing to do with what the market was actually doing. His discipline was reactive, not intentional. And reactive discipline is not discipline at all. It's anxiety with a rule book attached to it. What struck me most when I spent time with him was how clearly he could see the market when he was flat, when he had no position open. His read in those moments was sharp, calm, and usually right. The second he entered a trade, something changed. His eyes were still looking at the same chart, but his brain had switched into a completely different mode. The price action he had been reading so cleanly suddenly felt ambiguous, threatening, difficult to interpret. Every tick against him felt like evidence that he was wrong. Every pause felt like the beginning of a reversal. He wasn't seeing the market anymore. He was seeing a threat. And you cannot make good decisions about a market you are afraid of. So what did we do? We reframed the account. We stopped talking about profit targets. We stopped talking about drawdown limits in terms of money. We redesigned everything, every metric, every measure of success around one thing only. Was this decision consistent with your actual beliefs about the market? Not did it work, not did you make money. Did you do what you genuinely believed was right based on everything you know in the moment you had to decide? That became the only question, the only report card. And something shifted in him within weeks. Not in his results, not yet. In his experience of trading, he started to feel the difference between a decision made from clarity and a decision made from fear. And once you can feel that difference, once your nervous system has that data, you can actually begin to choose. Before that, you're just surviving. Here's where I need to stop for a moment, because I want to say something to you directly, not as a concept, not as a lesson as one person who has been completely lost in this work to another. I want you to hear this. Everything I've said so far is true. The reframe is real. The laboratory is real. The importance of building the mental software before you try to run money on it, all of that is true. And if that were the whole story, I would be giving you something genuinely useful. But it's not the whole story. And the half I've been leaving out is the half that determines whether any of this actually works. Here it is. The mental software you're trying to build cannot be built in simulation. It cannot be built in theory. It cannot be built by watching yourself make good decisions on days when nothing costs you anything. The software is only written in the presence of real risk, real money, real loss, real consequence. And here's the paradox that took me the longest to accept. If the risk doesn't genuinely hurt a little, the lesson doesn't take. A small account, used correctly, is not a limitation. It is the most efficient pain delivery system in existence for producing a calibrated trader. The small account isn't the obstacle between you and real trading. It is real trading. It is the only real trading that a person at your stage of development is actually ready for. And fighting that, trying to trade like you have 50,000 when you have 5, is not ambition. It's self-destruction wearing ambition's clothes. So let's talk about what this actually looks like in practice. Because this is where most people, even people who intellectually accept what I've been saying, collapse back into the same patterns. The first concrete thing I want you to do, not next week, today, in your next session or in your review after your last session, is this. Take your last 10 trades, not your last 10 wins or your last 10 losses, your last 10 trades, whatever they were. And for each one, I want you to write a single sentence answering this question. At the moment I entered this trade, did I genuinely believe it was the right decision? Or was I entering because I needed something to happen? That's the only question. Not, was it a good setup? Not, did I follow the rules? Did you believe it? Or did you need it? And be honest. The answer will tell you more about the state of your mental software than 6 months of performance data. Because what you'll find, if you look carefully, is that your losing trades are not randomly distributed. They cluster. They cluster around emotional states, around sessions where you were up and trying to hold on to it, or down and trying to get it back, or flat and impatient and just needing something to happen. And your winning trades also cluster around clarity, around patience, around sessions where for some reason the need wasn't there and you could just see. This exercise doesn't fix anything, but it shows you the shape of the problem. And you cannot solve a problem whose shape you cannot see. Now I want to go deeper into what the laboratory actually requires of you, because your account as a laboratory is only a useful idea if you understand what you're actually experimenting on. You are not experimenting on strategies. You are experimenting on your own responses to uncertainty. That is the only experiment that matters at this stage. The market is not a puzzle to be solved, it is a probability environment, and your job is to develop a nervous system that can operate inside a probability environment without demanding certainty. That is the skill. Everything else is downstream of that skill. Think about what that means for a moment. Most beginning traders spend the majority of their analytical energy on the market on reading charts, studying price action, identifying patterns, backtesting systems. And that work matters. I'm not dismissing it. But it is perhaps 20% of what you actually need to succeed. The other 80% is this. Can you take a valid signal and act on it without distorting it through fear? Can you sit with an open position that is moving against you within its expected range without the emotional experience of that drawdown overriding your judgment? Can you take a loss that was completely consistent with your edge and feel that loss as data rather than as punishment? Because here is what the market never tells you. Every loss is not the same. A loss that came from a sound decision made with full clarity about your own beliefs, executed with precision, that simply did not work out, that loss makes you better. It calibrates your probability sense. It adds to your experience of what the edge actually feels like in motion. A loss that came from a fear-based compromise, from hesitation, from adding a little to a trade that had already hit your stop, from re-entering a position that you'd already closed because you couldn't stand watching it go where you thought it would go without you. That loss makes you worse, not because of the money, because of what it teaches your nervous system about how to respond the next time you're in that situation. Every time you respond to fear with a behavior that produces temporary relief, getting out early, not entering at all, revenge trading, you are training the fear response. You are making it stronger. And you cannot outthink a response you have been training for months or years. You can only replace it by building a competing response that is more practiced, more automatic, more reliable. That competing response is what I mean when I talk about mental software. It's the set of automatic, effortless reactions that fire in the presence of market information reactions that are grounded in probability thinking rather than outcome certainty. And the way you build that software, the only way, is by making intentional decisions in the presence of real risk and then observing your own responses without judgment. Not fixing them in the moment, observing them. The fix comes from accumulation of observation, not from willpower applied to a single trade. Here's the second practice step I want you to add to your process. And this one you'll use during live trading, not in review. Before you enter any trade, before you click the button, say one thing out loud, or write it, or just complete the thought fully in your mind. Say, I believe this is a valid signal, and I accept that I don't know how it will resolve. I accept that losing this trade does not mean I'm wrong. Not as an affirmation, not as positive thinking, as a factual statement about the nature of probability. And then listen. Not to the market, to yourself. If you can complete that sentence and feel settled, enter the trade. If something in you resists that second part, if there's a voice that says, but this one I know, or I can't afford for this one to lose, that resistance is not a trading signal. It is a signal about your current psychological state, and you get to choose whether to enter from that state. What you don't get to do is pretend it isn't there. Most of the damage done in small accounts is done by trades entered from states that the trader refused to acknowledge. You cannot manage what you won't see. I want to spend some time on something that seems counterintuitive at first, and I think it's one of the most important ideas in this entire video. It has to do with position sizing, and it's the place where more small account traders do invisible damage to themselves than anywhere else. The conventional wisdom is size small, protect your capital, never risk more than 1 or 2% per trade, and for large accounts, that's exactly right. But for small accounts, accounts under $10,000, there is a version of that advice that sounds correct and is actually destructive. And that version is size so small that the outcome doesn't feel like anything. Here's the problem. If your position is so small that losing it causes no emotional response whatsoever, you are not practicing under real market conditions. You are practicing in a simulation that happens to involve real money. And the lesson from simulation does not transfer to real conditions. Your nervous system cannot distinguish between I was disciplined because the risk was so small it didn't matter, and I was genuinely disciplined in the presence of meaningful risk. One of those builds the forced software. The other one gives you the illusion that the software is being built while actually building nothing. So the question is not, how small can I go to protect my capital? The question is, what is the smallest position size at which I can feel the result where a loss genuinely registers as a loss? And a win genuinely registers as a win while still being a size I can afford to lose repeatedly without destroying the account? That number is different for every person. For some people it's $50. For some people it's $500. But that number is sacred because that number is where the learning actually happens. Below it, you're practicing. At it, you're training. I spent time early in my career with a coach who used to say that the goal of a small account trader is to have exactly enough pain and not $1 more. And I remember being frustrated by that idea because it felt like it was deliberately making things harder. I understand now that he was trying to help me thread a needle to stay in the zone where the consequences are real enough to matter, but not so large that they trigger the survival response that shuts down clear thinking. That zone is narrow. Finding it and staying in it is itself a skill. But it's a skill that pays compounding returns because every hour you spend in that zone is building the automatic responses that will serve you for the rest of your trading life. The third practice step I want to give you grows directly out of this. After each trading session, not each trade, each session, give yourself a score from 1 to 10 on a single measure. To what degree did I trade from my genuine beliefs today as opposed to from my emotional state? Not a performance score, not a profit and loss score, a clarity score. And track it, one number, each session, in a notebook or a spreadsheet or wherever you keep records. What you'll find over weeks and months is that your clarity score predicts your results far better than any other metric you track. On days when you score yourself a 7 or above, your results will tend to cluster around your edge. On days when you score yourself a 4 or below, your results will be scattered, not necessarily losses, but incoherent, as though a different person was trading. Because a different version of you is trading. And once you can see that pattern clearly, once the data shows you, beyond any self-deception, that your psychology is the primary variable in your performance, something changes in your relationship to the work. The market stops being the thing that's holding you back. You start seeing yourself as the thing you're working on. And that is the beginning of actual progress. There's something I want to address directly. Because I know some of you watching this are feeling a particular kind of frustration right now. The frustration that says, this all sounds good, but I actually need to make money from trading. I have bills. I have pressure. I don't have the luxury of treating this like a laboratory experiment. I hear that. I'm not dismissing it. But I need to say something that might be hard to hear. And I'm saying it with complete respect for where you are. If your financial survival depends on your small account producing income right now, then trading is the wrong vehicle for solving that problem at this moment. Not because you're not good enough, because the pressure that financial necessity creates is precisely the pressure that destroys the clear thinking that profitable trading requires. The market will not accommodate your need. It will do what it does, independent of what you need it to do. And if what you need creates urgency that distorts your perception of what the market is actually offering, you will take bad trades, consistently, expensively. And you'll explain them to yourself as bad luck or bad timing, when the truth is that need-based trading is simply not trading. It's financial desperation wearing trading's clothes. If you need money, find another source for the short term. Protect the account. Come to it clean. I realize that's easier said than done. I'm not pretending otherwise. But here's the thing. The trader who keeps the account small and intact while they do the real work of building their mental software, who doesn't blow it up under pressure, who graduates to a larger account when their clarity scores consistently show they're ready, that trader is 1 to 3 years away from real money. The trader who tries to force income from a small account under financial pressure is often 5 or 10 years away, because the damage to their psychological foundations keeps having to be rebuilt from scratch every time the account goes to zero. The timeline that feels slower is actually faster. That's one of the deepest paradoxes in this work, and it takes most people a long time to truly believe it, not intellectually, but in their bones. And believing it in your bones is the only version that changes your behavior. I want to talk about one more thing before we close, because it's the piece that ties all of this together and makes sense of why the laboratory framing is not just a nice way to think about a small account, why it is the only frame that actually produces growth. And that's the relationship between edge and belief. You will often hear traders talk about having an edge as though it's a property of a strategy, a pattern that has a positive expectancy, a system that has won more than it's lost over a large sample. And technically, That's accurate. But there's a more important meaning of edge that nobody talks about enough. Your edge is only as real as your belief in it. Because if you have a strategy with a genuine statistical edge but you don't believe in it when you're in the heat of a live trade, when the position is moving against you and every cell in your body is telling you to get out, then you will not execute the strategy correctly. You will exit early, or you will stay in too long, or you will add when you shouldn't, or you will skip the next entry because the last one hurt. And a statistically valid strategy that is executed incorrectly, inconsistently, from a state of doubt or fear, does not produce its expected results. The edge disappears. Not because the edge was never real, because you never fully owned it. Owning an edge means something very specific. It means you have taken the strategy through enough of your own personal trading history, under real conditions, with real money, in real emotional states, that you have first-person knowledge of its behavior. Not back-tested knowledge. Not theoretical knowledge. The knowledge that comes from having felt the drawdowns that the strategy inevitably produces, and having stayed in, and having watched the strategy recover, and having felt in your body that the recovery was real. That sequence, doubt, endurance, recovery, confirmation, is what converts a strategy from something you know about into something you trust. And trust not technique is what lets you execute correctly under pressure. A small account is where that trust is built. Not where it's demonstrated, not where it's tested after the fact, where it's actually constructed trade by trade, session by session, through the accumulation of exactly the right kind of experience. And when someone asks me what's the only strategy that works for a small account, this is ultimately what I mean. Not a pattern, not a setup. A deliberate commitment to building trust in your read of the market, in your ability to take action on that read, and in your ability to endure the uncertainty that will always accompany it. Every master trader I have ever known, without a single exception, has this. The ability to enter a trade with conviction, hold it through normal adversity without distortion, and accept the outcome as data regardless of whether it was a win or a loss. That ability is not a talent. It is not a personality trait you either have or don't have. It is a skill, a developable, trainable, absolutely achievable skill. And it is built in exactly the environment you're in right now, in the laboratory, with the small account, under the real but manageable pressure of money that matters without being money that destroys you. Let me tell you what I think happens to the traders who make it, who eventually move from small accounts to larger ones, from inconsistency to something resembling reliability, from desperate to measured. What happens is not that they suddenly get smarter about the market. What happens is that a critical mass of correct decisions, decisions made from genuine belief, executed cleanly, regardless of outcome, accumulates in their nervous systems until the default response to a valid signal becomes action rather than hesitation. They stop having to talk themselves into trades they believe in. The belief and the action become one motion. And when that becomes automatic, the energy that was being spent on managing the fear gets redirected into reading the market more clearly. Suddenly they see things they weren't seeing before. Not because the market changed, because they stopped seeing the market through fear. That is the transformation. And it doesn't happen on a schedule. It happens when it happens, which is always later than you want it to and earlier than you think it will. The only thing that accelerates it is intentional, consistent, honest engagement with the three practices I've described today. The retrospective audit of belief versus need. The pre-entry declaration of uncertainty acceptance. And the daily clarity score that keeps you honest about the gap between who you want to be as a trader and who you are on any given day. You are not behind. You are not too late. The traders who blow up their small accounts in pursuit of big returns and then have to start over, they are behind. You, right now, if you understand what I've shared with you today and you begin to apply it with intention, you are in the most productive possible position. You have a laboratory. You have real stakes. You have not yet formed the kind of bad psychological habits that take years to unlearn. You are exactly where the work begins. Every time you sit down to trade this week, ask one question before anything else. What am I actually trying to accomplish in this session? If the answer involves a dollar amount, if it's I'm trying to make $300 or I need to cover this week's expenses, stop. That's not an intention. That's pressure wearing the costume of a plan. Replace it with something like, I'm trying to make 3 decisions today that are entirely consistent with my actual beliefs about what the market is doing. 3 decisions from genuine belief, no outcome requirement attached. Measure the session only by that. The account will grow, not because you forced it to, because you gave it the only condition under which it can sustainably grow you, operating from clarity, building software that compounds over time in the only laboratory that actually produces it. Consistency is not a result. It is a state of mind that eventually produces results. And the small account, used the way I've described, is the fastest path to that state of mind that exists. Not a stepping stone to real trading. Real trading, the realest trading there is, if this reached you today, if something in here shifted even a fraction of the way you're relating to this work, then please share it with someone else who's in the same place you were when you clicked on this. Because that person is searching. They are frustrated and close to quitting and hungry for something real. And what I've shared here exists for exactly them. Leave a like so others in that place can find it. And if you want to continue this conversation, if this is the work you've been waiting to do, subscribe, not for me, so that the next time I sit down to talk about what trading really requires of a person, you're there.